Hey, Saretsky here. Welcome back to the show. I want to walk you through a conversation I had the other day. I had a prominent policymaker call me up and say, "Hey, I want to talk about housing. I want to know what's happening. What are you seeing in the data? What are you seeing on the ground? Walk me through sort of the risk. What should we be paying attention to again as a policymaker?" And so I kind of want to walk you through that conversation because I really said, listen, there's a couple things here, which is everybody's kind of reading the media headlines and is painting the market with these broad strokes. First of all, the risks in Canada are predominantly concentrated in the GTA and in Greater Vancouver. Of course, the two most expensive, most frothiest housing markets that have seen the largest run up in home prices over the last several decades. So, first of all, that's your number one is there's predominantly in two cities. Number two is it's predominantly in a certain product type, which is the condo market, number one, but more specifically, it's actually really concentrated in the new construction condo market. So that's the pre-sale market. Remember, we've talked about it on the show at length, which is, you know, you've got new home sales in the GTA, new condo sales are running at 30-year lows, 30-year lows. Then you have to account for how much the city and the population has grown over those 30 years. I think in the month of April, right, you had just over 100 condo sales in the entire GTA. That's down from a peak of roughly 4,000 units in the month of April. So you have basically an entire industry which is closed for business. In Greater Vancouver, where I am here, you've got pre-sale units running near 10-year lows. And so, it's bad, but it's not GTA bad. So that's number one is your risks are concentrated in that market. He says, well, what's going on in the pre-construction market? Like, why is it so bad? And basically what's happened is the investors have disappeared. Okay. So why did the investors disappear? Well, you have to understand, first of all, you have to understand the dynamics of the pre-construction market to begin with. Pre-construction market, um, we've had this long raging bull market in Canadian housing. And one of the best ways to play a levered asset is through the pre-construction market because what is a pre-sale contract? It's just a futures contract. Okay. You put down 5% or 10% or 20% down and you basically are buying a piece of paper with obligation to close on that unit 3, 4, 5, sometimes 7 years down the road. And so, if you want to take sort of a speculative levered bet on housing, you would do that through the pre-construction market. Now, when resale prices are rising at one point, your resale prices were rising 27% on an annual basis in 2021. When you get that level of growth, people start extrapolating. They get excited. They get worried about the future, about owning a home or having their kids own a home. So people again enter into that speculative market, which is the pre-sale market. And so people just started extrapolating essentially these infinite returns, just well, housing will automatically go up 3, 5, 7, 8, 10% a year. And so what you saw was basically um, as that was playing out, and you had record housing starts happening during that period, right? Because if everyone's buying pre-sales, developers are obviously actively putting shovels in ground. And so what you basically saw was costs started to inflate dramatically. So not only land costs, but construction costs, and that those costs, development charges, cities were taking their pound of flesh as well. That was ultimately getting baked into the price of a new construction unit. And they said, well, listen, if the resale market is at $1,000 a square foot today for a 2-year-old condo building that's completed, we'll charge you $1,200 a square foot for a product we're going to deliver in 4 years from now. And you'd say, well, I mean, listen, like prices are going to continue to go up in 4 years. Maybe that'll be a good investment. Maybe I can flip it. Maybe I can rent it out. And so that was the dynamics that was playing out in the pre-construction market. Basically, the cost of new housing got so speculative that it ran so far above the resale market to the point where basically new construction units were selling 10 to 20% above the cost of similar resale product. And so again, keep in mind you also have to add 5% GST on the cost of new housing. And by the way, new construction units, pre-sales, buying pieces of paper come with insane amount of risk, which people obviously forgot about those risks. And so basically what we're seeing now is As interest rates rose, the bubble essentially popped. As you've seen rents declining and immigration, the taps on immigration turning off, that has basically popped as well. And so, as you're a pre-construction purchaser today, they remember pre-construction units. Well, 70% of the purchasers are investors. And why is that? Well, because A, it's a speculative investment. If you're an end user and you're going to live in the property, you're typically not wanting to wait 5 years for delivery. You're typically wanting to walk through and understand what the exposure is, get a feel for the floor plan, look at the finishings. You want to touch and feel things. So that's why they're predominantly sold to investors. And that's about 70% of the market, the pre-construction market is investors. And so if you remove um, the fact that what we're seeing today in the resale market is you're seeing prices aren't going up. They're actually declining. Prices are declining. Rents are declining. And by the way, the number one story that was sold to everyone was immigration. Remember, we were adding 1.2 million people to the Canadian population, the highest in 50 odd plus years. We were adding 1.2 million people to the population. So people were again extrapolating. All of that is now unwinding. Rates have, basically effectively tripled. Rents are declining, and immigration is now at a point where we just got the latest immigration stats. You have population growth in Canada now running at essentially 0%. If you look at the non-permanent resident cohort, it was the lowest, third lowest, and basically going back to the 1950s. And one of those 3 years was the pandemic shutdowns when the borders were closed. So you basically have a situation where immigration growth, as tremendous as it has been, at least for the real estate industry, it is now going to zero. In fact, the government has told you they want to get the share of non-permanent residents down from 7% today down to 5%, which means more people, more non-permanent residents, immigrants basically need to leave. You need to go. That's what the government is effectively telling you. So population growth is going to run at zero for the next couple of years. Again, assuming the government actually sticks to their word. So all of these sort of narratives and stories around the pre-construction market are evaporating. And so you have a scenario today where that market has essentially collapsed. That market basically no longer exists. And this is what I said, to the policymaker, which is like, listen, your largest risk is actually the fact that once this is shutting off today, the largest risk today is the unemployment rate in the construction sector. Okay, you've got near record high number of units in the pipeline that are actively being built. But once those are built and completed over the next 12 to 18 months, there's not going to be a lot of work for these people to go to. Remember, pre-sale units, housing starts, understand how the funnel works. A housing start, as designated by CMHC, is basically when the building gets built back to grade. What does that mean? It would be effectively the timeline for what a housing start is via CMHC standards is, you year one, you pre-sell the unit. Year two, you dig the hole. And then year three, you're back to grade on many of these condo buildings. So housing starts, the numbers that you're looking at today in the media is essentially activity that happened 2 years ago. So if you want to get a precursor to where housing starts are going, there you have to look at the pre-construction market, which I just told you is running at 30-year lows in the GTA, your largest metro, and 10-year lows in Greater Vancouver. So that's the direction of new housing and where it is going. So when the government says, hey, listen, we're going to build whatever it is, 500,000 new homes a year, when the all-time record high is 270,000, and you've got pre-construction units running at 30-year lows, that is a lie. And so my biggest concern is what is going to happen to the construction workers as these projects complete and there's nowhere for them to go, because it's a specific skill set and it's a specific industry that builds high-rise towers. You can't just take a lot of these trades that are designed and built for constructing high-rise condos and going and putting them on duplexes and triplexes. That's a very different. It's a different business. It's a different skill set. It's a different laborer than it is in many circumstances for these high-rise units. That's actually my biggest concern, is that you have this entire industry which employs roughly 7 to 8% of the labor force number one. But number two is you have all these municipal governments that have gotten so greedy around development charges, development fees on new developments that one of their largest revenue sources is actually going to be extinct. It's going away. And so they're going to have to find different places for revenue generation. That is going to be a real problem. It's also going to be a real problem on the tax revenue side or property transfer tax revenue side in places like BC here. So these are the biggest, I think, signposts to keep an eye on. Again, all you have to do is look at what's happening on the immigration side. Keep in mind that you look at, so immigration again going to zero. We've got vacancies ticking higher right now. You've got rents down double digits. And again, in places like Vancouver and Toronto, Calgary's now coming down as well. And you have 7%, 7% of the entire um, of the rental stock under construction today. So we've been building a lot of rentals in the pipeline. Okay, so you've got 7% of the total rental supply currently under construction, and that's going to be completing at a time when rents are already declining. This is great for affordability, but it kind of feeds on itself, and it's actually opening up a lot of risk to CMHC, Canada Mortgage Housing Corporation, because what they've done is they created a program that worked. It did its job. It worked, which is they created a program called the CMHC MLI Select program. What this effectively is, it's very cheap subsidized loans to developers that are building purpose-built rental housing. And so effectively what it is allows developers in many circumstances to basically develop and construct 90 up to 95% loan to value or loan to cost. 95% of the project can be financed through construction. So very, very high leverage. And at the end of the project on an equity takeover perspective, again, you can finance up to 95% and you can take on a 50-year amortization. So because of this favorable financing, you've built a lot of rental housing to the fact that where I just said, you've got a record number of rental units under construction in the pipeline, which again is going to help push rents down at a time when immigration is flatlining. But the risk is to CMHC, which now owns roughly 90% of the portfolio. CMHC owns 90% of the rental construction financing outstanding. So they have a massive taxpayer liability where, as you see declining rents, this is going to disrupt pro formas, and this is going to require equity injections from a lot of these developers. And I think there's a lot of them that are going to be ultimately offside. So you have the default risk is rising significantly. So this is the real risks that are out there in the market. I had to laugh because after the conversation, I'm scrolling through Twitter, and the following day I see an article from the Global Mail saying CMHC gives up on goal. They give up on their goal to return to 2004 housing affordability levels. And the reason for that is because, well, quite simply, if housing affordability got back to 2004 levels, the CMHC would no longer cease to exist. In fact, they would be insolvent. This would require a massive home price correction, which would also require falling rents as well, which would tip their portfolio offside. Keep in mind, I just told you they own roughly 90% of the rental construction financing outstanding. So, if you have declining rents and you have declining home prices, it's pretty easy to see you're insuring all these first-time home buyers on new purchases as well, that you become insolvent pretty quickly. And so that so they said, listen, we're gonna not, we're gonna abandon our 2004 housing affordability level. We like to bring them back to 2019. Okay, 2019, great, no problem. But in order to get back to 2019 prices, it would require about a 35% drop in national, not just the GTA, but national home prices, 35%, which again will put CMHC in a very peculiar spot, I should say, if you saw a 35% nationally to bring you back to 2019 pricing. So I always find that very fascinating that they have these models in place of where they want to go. But if they do get there, interesting things happen. So the risk again out there in the market today are what is going to happen to the construction workers, which is a huge part of the labor force and of economic activity, all the spin-off from that employment, and also what happens to the CMHC as well in terms of declining rents, flatlining immigration. And what we're seeing, this big article out this week is, layoffs at a large Vancouver developer called West Group comes out and says, listen, we've just had to, in our 60-year history, this is one of the most difficult days, saying that we had to lay off a huge portion of our team. But this is just one developer that's gone public. In fact, I can tell you for a fact there is several of the other large developers that have been already laying people off, although not announcing it publicly, that it is already beginning to happen. And so this is all playing out now in real time. Keep in mind, we did a video, 4, 5, 6 weeks ago, telling you that the largest pre-sale marketing firm in Vancouver, and for that matter, in BC, the largest pre-sale marketing firm just laid off 25% of their staff. I mean, that's basically telling you, again, when you look at the data, you look at the anecdotes, and you can add it all up to say there basically ceases to exist a pre-sale market today, and that has been a huge driver of economic activity. So the real risk, again, it's not in, old granny's single family house in a nice little neighborhood. The risks today are in the new construction condo market and in that industry specifically, because again, you can drop rates to zero, but to get sales moving again, it's a very long process, and you have to get the investor confidence back in the market to drive that machine forward. And how do you get the investors back into the pool when they've been scarred through, significantly higher interest rates? Again, remember, keep in mind they went from effectively 0 to 5% in a matter of a year and a half. So you had this massive jump in interest rates, and you have, again, declining rents, and now you have the immigration story fading away from record immigration to near record low immigration. The conversation and the sentiment in that industry has changed significantly. And so those are really the risks that are out there today. And that's kind of what I'm keeping an eye on moving forward is we'll continue to see more of these insolvencies in the space as well. I think are percolating, and these things take time to play out, but they are in fact playing out regardless of what Tiff Macklin with the Bank of Canada does over the next 6 to 12 months. This is a slow moving machine that is going to take time to kick back up. And we'll see what happens with a lot of our skilled trade workers that we were originally so desperate to attract to the country. Now, many of them, in fact, will be looking for work. So that's what is keeping me up. That's what some of my conversations have looked like in the last week or so. And as always, hope that helped. See you next week.